Steve here. Let's get right into this explainer of the market ledger. Go ahead and pull up a chair, sit down at the desk, and let's get straight to the tape. We're doing a gritty, end-of-day desk review today, because the friction building in the background is just getting way too loud to ignore. If you're looking for sugar-coated market spin, man, you are in the wrong place. We're looking at the raw numbers, the heavy charts, and those geopolitical trapdoors waiting for us at tomorrow's morning bell.
The 4 p.m. bell just rang, and let me tell you, it brought a whole lot of cold water for the quote-unquote hope trade. Look, while the retail crowd was busy staring at that S&P record from Monday, taking victory laps and patting themselves on the back, the smart money was doing something very, very different. They were watching the yields. They were watching the energy pits. The friction is finally starting to show up on the tape, and we need to pay attention.
All right, Part 1, the closing tape reality. Let's look at the morning ledger.
Here is the verified reality of the Wednesday close. The S&P 500 finished at 7,444.25. It punched through to a new record close, up about 0.6%. But listen, don't let that green screen intoxicate you. Brent crude is sitting stubbornly at $107.50. It is absolutely boiling right now. Gold recovered to over $4,700, proving that the safe haven bid is still very much alive and kicking. And Bitcoin? It's in record territory, stalking that 80,944 mark. So you've got a tech-heavy squeeze happening at the exact same time as a massive safe haven flight. That, my friends, is a glaring contradiction.
Now this brilliantly illustrates what I mean when I say house of cards. The tech-heavy squeeze tried to stage a comeback today. We saw the indices rip higher as the algos reacted to this perfect Goldilocks jobs narrative being peddled out there in the financial press. But notice those dangerously thin volume bars supporting the move. The algorithms are pumping up a low-volume, fragile market, and there just isn't a solid foundation of conviction buying underneath it all.
And here is your counterweight Brent crude, stubborn at 107.50. While equities are out there celebrating, the smart money down in the energy pits is betting heavily against a quick geopolitical resolution. These energy traders are just not buying the peace story. They are pricing in risk. Look, when the S&P is making new highs on incredibly thin volume and oil is flat out refusing to break down from 107, you trust the oil chart, always.
Moving on to Section 2, the red folder warning and the inflation trap.
Now, this morning's data confirmed the pain. We are looking straight at a stagflation fire. What exactly is that? Well, it's an economic trap. U.S. inflation at the wholesale level came in significantly worse last month than the economists were expecting. Inflation is currently outpacing wage growth for the very first time since 2023. This is that red folder morning news anchoring the higher for longer interest rate thesis. Add in the fact that we're seeing a structural productivity gap, meaning productivity simply cannot keep up with soaring energy costs, and you've got a serious problem on your hands. If the economic engine is already overheating, you can't just step on the gas.
And that brings us to the mathematical gravity of the whole situation, 5%. The 10-year Treasury yield is creeping right up toward that 5% handle. In my world, we call this the valuation ceiling. Think about it for a second. When the risk-free rate pushes this high, the massive PE multiples on these tech giants absolutely have to come down. It's not a matter of opinion, it's just basic math. The cost of capital is literally choking out those growth models.
Section 3, the geopolitical binary trap, centering around the Beijing summit.
The physical reality over in the Strait of Hormuz is a far cry from those social media victory posts you might be seeing. Step 1, the strait is frozen. Independent trackers are showing near zero commercial movement. Step 2, that 48-hour power plant ultimatum, it's been suspended. Trump has signaled that the threat to obliterate Iran's domestic power grid is entirely subject to the success of ongoing discussions. Which brings us to Step 3. President Trump is meeting with President Xi in Beijing today. The threat of a dark grid hangs completely on the success of this summit. It is a high-stakes ultimatum trap, plain and simple.
All right, Section 4, bull versus bear. Let's do a little sentiment analysis.
On the left side of the ledger, you have the bullish view, the Beijing dividend. This is the bet that Trump and Xi managed to force a signature by the Monday open. If that actually happens and the strait reopens, an S&P 7,500 is an absolute lock, and we'll probably see oil crash back down to the $80 handle. But on the right, you've got the bearish view, the ultimatum trap. This is the stark reality where the counteroffer is rejected, labeled totally unacceptable, and Operation Epic Fury resumes. If the bombing starts on those power plants tomorrow, $100 oil was an absolute gift. We'd be talking about a catastrophic $150 Brent crude by Friday. A one-page memorandum doesn't clear a minefield, folks.
And finally, Section 5, the Smart Money Directive, some professional advice for the road.
I want you to consider this number, $397.4 billion. That right there is Berkshire Hathaway's massive cash hoard. Greg Abel was a net seller of stocks this quarter. Listen to me very carefully on this. He isn't missing the boat. He is earning 5% on treasuries, totally risk-free, and he is just waiting for the interest rate reality to sink the boats that are out there over-leveraged. That, gentlemen, is what true institutional discipline looks like.
So as you step into the Thursday session, here is the hard-nosed trading discipline you're going to need to survive. Ignore the noise. First up, watch that 7,400 S&P floor. If we fail to hold 7,400 right on the open tomorrow, the melt-up is officially over. The sand gives way. Second, trust the energy pits. Crude at 107 is basically the only honest indicator we have right now. They usually sniff out the truth first. Third, trade small sizes. And finally, for the love of the game, keep your stops tight. Do not get caught on the wrong side of a binary gap down.
I'm going to leave you with this final thought. The ledger doesn't wait for latecomers. It doesn't care about your hopes, and it sure doesn't care about your feelings. It only cares about execution. So, are you following the smart money, or are you just out there gambling on thin volume headlines? Stay disciplined, watch your averages, ignore the noise, and prepare for the morning bell. This is Steve. The ledger is closed.